You feel like the world is getting crazier, but your paycheck still works like it did in 2019. That mismatch is the point. While you are trying to survive inflation and rent, the wealthy are quietly reshuffling their balance sheets like they already know the ending, and you do not. Here is what nobody explains in plain English. In 2026, the price action in gold and the price action in American stocks are not two separate stories. They are one story about power, about currency credibility, about who gets protected when money gets devalued. This is not financial advice, this is financial education. I want you to understand the mechanism, because once you see it, you will stop asking the wrong questions, you will stop worshiping headlines, and you will start recognizing when the system is running a play on ordinary people while pretending to be fair. Let us start with the question that keeps popping up everywhere. Should you buy gold because it is going up, or because you are afraid the economy will collapse? And the other question, the one people whisper with their brokerage apps open: should you buy American stocks because the market is up or because technology is still strong? In theory, those are two different bets. In reality, they are the same bet. They both reflect how the global economy is being repriced in real time, and they both reveal which side of the money equation is being protected. Now, the uncomfortable part: if gold is rising at the same time that American stocks are rising, most people conclude it means the world is stable. They think the market is telling a comforting story, but price is not comfort. Price is information. And when gold and stocks both rally together, it usually means you are watching a transfer of wealth, not a normal economic cycle. Picture a casino where the lights flicker and the dealer keeps smiling. You see two winning games at once. You assume the house is being generous. But deep down, you should ask a colder question. Why would the casino pay winners in both directions? Because the casino does not need you to understand. The casino only needs you to keep playing. And here is where the story gets truly ugly for people who grew up believing rules were rules. Your class position can become sticky, not because you failed, not because you are lazy, not because you are dumb. It becomes sticky because the system is optimized for slow transfers, for predictable outcomes, for you to keep renting your future while the wealthy hedge theirs. If you want the 2026 frame, it is impossible to ignore. AI is deleting jobs faster than most people understand. The replacement is not a better job market. The replacement is fewer workers, more software, and contracts that turn into profits for the same shareholders again and again. Housing has detached from wages across the United States, the United Kingdom, Canada, and Australia. Inflation may have come down in official numbers, but your purchasing power never climbed back to 2019. You still feel it every time you buy groceries, refill prescriptions, or renew a lease. Meanwhile, the top 1% keeps concentrating wealth and the stock market keeps posting highs. That disconnect is not accidental. It is not a mystery. It is a sign that someone is funding the winners while you are absorbing the damage. So why does gold rise and American stocks rise at the same time? What would make those two assets move like they are cooperating? There are two broad reasons, and one of them is the most important for you. First, gold sometimes rises not because of war, but because of distrust in the dollar and in the ability of policymakers to protect the value of money. Second, American stocks can rise even when the economy is shaky, because stocks represent claims on companies that can pass costs to consumers, reduce labor through automation, and refinance debt when rates and liquidity conditions allow. In plain terms, stocks can rally while the average person suffers, because corporate profits can survive longer than your paycheck can. But even that explanation is not enough, because it does not answer the deeper question: why would the global system allow the purchasing power of the world's creditors to quietly evaporate while the debtor keeps access to capital? And here is the part nobody wants to say out loud. The system is built to prevent the debtor from defaulting in the way you imagine default. The system does not allow collapse in the dramatic movie sense. It allows collapse in the quiet bookkeeping sense. It allows the real value of debts to be reduced through inflation, through currency debasement, through interest rate policy, and through market interventions that keep the debtor solvent while forcing losses onto the holders of currency and bonds. Let us put a face on it. A nurse named David is 32 years old. He works nights. He uses overtime when he can. He bought a small car because the repairs for an older one got too frequent. He is not dreaming about luxury. He is just trying to stay ahead of the calendar. Then he opens his bank app and sees that groceries cost more, and his rent renewal is higher, and his savings account yields nothing meaningful. His official salary numbers look fine, but his real-life math feels broken. Later, he sees a friend at work talking about investing. The friend says the stock market is near highs again, and that it means everything is fine. David wants to believe. He reads headlines about interest rates stabilizing. He hears that inflation is not as bad as it was. Then, one day, David checks his retirement plan contribution, and he notices the fund is holding corporate and government debt, directly or indirectly. He does not understand bond math, but he knows one thing. The value of his retirement is not rising as quickly as the headlines suggest. He feels confused. That confusion is manufactured. And now we are going to connect the confusion to the mechanism. When people talk about bonds, they talk like bonds are paper with fixed rules. But bonds are not fixed. They are priced continuously based on expected interest rates and expected inflation, and they are exposed to liquidity shocks. When the central bank pushes the environment in a direction, bondholders absorb the losses. Then, when conditions get too painful, interventions appear like rescue boats. Those rescue boats do not come for free. Rescue boats are paid for by changing the currency and by changing the price of risk. If you are the person holding currency and long-duration assets, you are the one paying. This brings us to the second major idea, the one that turns gold versus stocks into life versus the system. Gold is rising because it is a hedge against currency debasement and against the real erosion of long-term purchasing power. American stocks are rising because capital flows into the future where growth can still be extracted, especially through technology and through automation. Those two things can happen together because they are not the same claim. Stocks are claims on cash flows from businesses. Gold is a claim on something older than policy. Stocks rise because companies survive and because some investors believe growth will continue. Gold rises because those same investors and central banks are preparing for a world where money itself loses value over time. This is not a conspiracy. It is the normal outcome of a world overloaded with debt, and the debt number is not small. Global debt now exceeds $300 trillion. That means every major economy is locked into a machine that needs refinancing. When debt is that large, governments cannot afford the kind of financial pain that would trigger default in the way you imagine. They manage the pain instead. They manage it by inflation when possible. They manage it by interest rate policy when inflation is politically or economically inconvenient. They manage it by liquidity adjustments through the central bank. And when markets break, they manage it by stepping in. So when you see a stabilization in interest rates on paper, do not confuse that with stabilization in your life. Inflation may slow, but purchasing power damage is not erased. It is like a cut. The bleeding stops, but the scar remains, and you feel it every time you pay. Now let us go deeper into the gold story, because this is where most people get trapped by the wrong narrative. People assume gold only moves when wars expand or when people are panicking. That was often true in earlier decades. In the last few years, after the shock of major geopolitical events and after the pandemic-era policy response, the gold narrative got more complicated. In 2026, gold's biggest tailwind has been distrust. Not just distrust of geopolitics, distrust of currency and distrust of the long-term math behind government financing. And here is where you need a 2026 reality check. AI is making labor cheaper. That means wages can be pressured for longer than before. Insurance costs and climate-related disruptions can rise. Supply chains can be fragile. Events like wildfires, floods, and migration shocks can hit regional budgets. And none of those problems disappear because interest rates pause. So if wages are pressured and costs keep creeping, governments still need revenue. If revenue is not enough, debt grows. If debt grows, the future becomes riskier for everyone holding nominal claims. That is exactly where gold benefits. Gold is not paying you a coupon. Gold is not a business. Gold is a signal that some people want protection from the unit of account itself. Now, why does American stocks keep rising? Because the wealthy do not just buy one hedge, they buy upside. They buy survival. In 2026, many large companies can reduce headcount through automation and AI tools. They can compress payroll costs, they can improve margins, they can negotiate with suppliers differently. And when markets reprice, the assets held by big portfolios benefit from liquidity, from risk-on sentiment, and from the sheer fact that central banks and large institutions can create conditions where risk assets recover faster than ordinary people can recover from real-life cost pressures. So again, the two assets can rise at the same time because they are responding to different layers of reality. Gold responds to the erosion of trust in money. Stocks respond to the ability of capital to keep producing profits in an environment where the winners are concentrated. But that still leaves the most unsettling question. If the dollar and the bond market are under stress, why does the United States keep functioning like a safe haven? Here is the mechanism in plain language. When a country is deeply indebted, it cannot simply stop paying in a normal way. It manages the repayment through the price level of money. Higher inflation or persistent debasement reduces the real burden of nominal debt. Even if headline interest rates change, the real purchasing power cost to service and refinance debt can shift. Now imagine you are the creditor, not an investor with a spreadsheet. Imagine you are a pension, an insurance company, a national reserve manager, or a family office that lent capital because you trusted the system. If the real value of what you get back shrinks, you do not get your money back. You get money that buys less. So bond weakness and currency weakness are not just market movements. They are a hidden tax on creditors, and here is where ordinary people get lied to. Ordinary people are told the pain happens to the debtor. But in a managed debt world, the pain is often distributed to the creditor class first. The debtor can survive because policymakers have tools. Creditors can be forced to absorb losses through mark-to-market declines, through yield changes, and through inflation. Let me make it visceral with an example. 30 years ago, someone lends $1 million. Over time, they expect that million to be paid back. In a stable world, that million returns with a predictable purchasing power. But if inflation compounds and the price level rises dramatically, the $1 million at the end buys less than it did when it was lent. Now scale that logic up. Multiply it by decades, multiply it by billions, multiply it by the fact that the United States borrows not just from citizens, but from the entire world. Then ask yourself, if the dollar loses purchasing power, who loses purchasing power? The answer is not the person who owes the debt. The answer is the person who holds the currency and the claims that are being repriced. So when gold rises while the dollar weakens, and when bond prices wobble, the market is not saying the world is healthy. It is saying the value transfer is underway, and this is where the cliffhanger matters, because the gold price chart is the tip. The real story is the supply chain of protection. In 2026, you are watching central banks and institutions compete for hedges. World Gold Council disclosures and market reporting show central bank purchases increasing over recent years. Even when the amount each country buys is smaller relative to the size of the gold held by the biggest holders, the direction matters. It means official sectors are not sitting still with their reserves, they are diversifying away from pure currency exposure. Now here is where you have to be intellectually ruthless. If the world buys enough gold to replace the entire dollar in bond market, the dollar would face a dramatic threat. But that does not happen quickly, because gold is finite, and because official buyers are incremental. The United States holds massive gold reserves on official estimates, whether you accept every number or not. China has been a notable accumulator. Yet the pace of accumulation is still slow compared to the scale of the global monetary system. That means the United States does not fear everyone switching to gold tomorrow. Instead, the United States benefits from something more subtle. The dollar can weaken gradually while the system still functions. The price of gold can rise while the debtor remains able to issue debt. So gold becomes a hedge, not a replacement overnight. That is why the gold bull market can extend even when nobody is declaring a total collapse. Now let us talk about the real trigger for your decision-making in 2026. You are asking whether the gold cycle is over, and you are asking whether you should chase performance. Most people are trapped in the investor superstition. They think the right move is to guess when the peak ends. They think they need to predict whether the market will go up next week, next month, next year. That is not investing. That is gambling with extra steps. The cold truth is simpler. If the underlying drivers remain, the cycle can continue. If the underlying drivers break, the cycle ends. So what are those drivers for gold? First, the dollar's direction. Gold tends to benefit when the dollar weakens because real purchasing power protection becomes more valuable. Second, the trajectory of real interest rates. If real yields fall or if market expectations shift toward easier policy, gold has room to run. Third, the bond market credibility. If long-duration government debt prices struggle, and if the market believes it will be a long time before inflation is meaningfully contained and before debt financing becomes painless, then gold benefits. Fourth, the inflation narrative itself. In 2026, you can no longer pretend that headline inflation is the same as purchasing power. The loss of purchasing power can persist even after central banks claim success. People can be told inflation normalized while their experience stays brutal. Fifth, risk appetite. If investors believe the economy is fragile but still liquid enough to support equities, you can see gold rising alongside stocks. That is not contradictory. That is a sign of a split market, protection buying for hedges and risk buying for growth. Now here is the pattern interrupt. I want you to stop thinking of gold and stocks as opposing religions. In 2026, they are instruments that different institutions buy for different needs at different times. Gold buyers are often central banks, reserve managers, and cautious allocators. Stock buyers include both long-term investors and risk-on capital. If those pools are different, both can buy at the same time without contradicting each other. And this is why your personal strategy cannot be based on one chart. But we still need to address the part nobody wants to admit. Most people do not fail at investing because they lack information. They fail because they buy emotionally. They buy when they feel safe. They sell when fear hits. They chase after a rally. They hesitate at the wrong moment. They freeze at the peak because their identity is tied to not being wrong. In 2020, a lot of people were told to learn to code. They believed the future was accessible if they just acquired the right skills. But in 2026, AI writes software faster than most new programmers can learn it. The job pipeline changed, and the training advice did not update fast enough for reality. The people who believed the world rewarded effort, not systems, found themselves competing against machines and against cheaper labor arrangements. Now apply that same error to investing. People believe the market rewards bravery. It does not. It rewards execution and discipline. It rewards process. It rewards those who can survive drawdowns without panicking. Here is a micro story you probably recognize. A retail investor in his 40s opens his brokerage account in late 2021. He buys after watching a stock rise. He thinks it will keep going because it already proved itself. When the market drops, he holds because he tells himself it will come back. When it does not return quickly, he sells in a panic. Then he sits out and misses the recovery. He then chases the recovery again at a higher price. This cycle repeats because his strategy is not a strategy. It is an emotional loop. The wealthy do not have to get every trade right. They have to avoid catastrophic mistakes. They have to manage risk and preserve capital. They also have systems and access, faster information, better liquidity, and sometimes direct relationships with institutions that allow them to move when others cannot. Now you might think that sounds unfair. That is the point. It is unfair.